Banking conditions for banks in the 9th Federal Reserve District were mixed in the first quarter of 2014. I'm Ron Feldman. I'm the Executive Vice President of Supervision, Regulation, and Credit here at the Federal Reserve Bank of Minneapolis. And today I'm going to discuss banking conditions in the 9th District. Just to remind you, the 9th District consists of the states of Minnesota, Montana, North and South Dakota, Western Wisconsin, and the Upper Peninsula of Michigan. And we're just going to be talking about banks that are headquartered in those states. Overall, I characterize banking conditions as being mixed to the slightly on the weaker side of mixed. There was a small increase in the number of problem loans that banks had in the district, but that ends up not being a big deal because problem loan levels for most of the states are rather low. Of more concern is that profitability was flat across virtually all the states in the district, and that's unusual for the first quarter where we normally see gains. On the positive side, there was strong improvement in loan growth across most states. So let me provide a little bit more detail on each of these points. First, let's turn to problem loan levels. So what you're looking at here in the graph on problem loans, which are loans that are not being paid on time or in full, relative to the financial resources that banks have to absorb the losses. The dark purple line, or the solid purple line, is the median bank. So if you lined up all the banks in the district, this would be the one in the middle in terms of its problem loans. And you can see that there was a little bit of an uptick in the amount of problem loans relative to these resources the banks have to absorb the losses. However, you can also see that relative to the 20-year median, with the dark black line, problem loans are quite below that level. So if you think of that as being a historical normal level, you can see that problem loans are quite low right now. So even a small uptick is really not a big deal. Problem loan levels are quite strong. By that I mean they're quite low. Profitability, on the other hand, is a little more problematic. Here you can see that rather than being more favorable compared to the median, it's actually below the median by a substantial amount. Moreover, the first quarter where we normally expect to see gains, we don't see that. We actually see a decline. And you can see that in the first quarters over the last several years there's been improvement. This is suggesting that we're not quickly going to be returning to the pre-crisis level of profitability. Now, what's the source of this? And just to be clear, this is quite true across all the states in the district except for South Dakota. So you can see here we've graphed all the states. On the top panel are the states that have profitability levels above the 9th District as a whole, and on the bottom panel we've got states where it's below that, and only South Dakota saw an increase in profitability. So what's driving this is twofold. First, banks were getting some income off of provisions. So provisions are normally a cost for a bank. It's the money that's set aside to absorb future losses. But as the expectation for future losses declines, because we just saw there's not many problem loans, banks can put less and less aside. Indeed, they can even take some money out of their provisions. So rather than being a cost, if you're taking less than you did last quarter or even taking income in from provisions, it's actually something that's going to increase your profitability over time. But you'll note here that this ratio of provisions relative to assets is now at 0. And it could go negative, but that would be something we haven't seen for over the whole period we've been looking at. And so it really tells you that there's relatively little left for banks to be using provisions as a profitability source. At the same time, the net interest margin, which is the difference between the earnings banks have on their assets, which are securities and loans generally, relative to how much they have to pay to get that money, was declining. And this is really the bread and butter source of income for banks. And as it declines and there's no more income for provisions, you can see why you might not, if you're a bank, earn much money in this first quarter. Again, suggesting this is something that we need to keep our eyes on and see if we have any real chance of getting back to before pre-crisis levels. Of course, it's going to vary by the state and the district, but overall for the district, you can see we're substantially below what the 20-year norm has been. In contrast, loan growth was quite strong, and you can see we're almost back to the 20-year norm. Another way to look at this same information is to look at it by what percent of banks had positive loan growth. And you can see it's about 75%, so almost all the banks in the district had positive loan growth. And looking across the states, you can see all the states besides the Upper Peninsula of Michigan and the western portion of Wisconsin had positive loan growth. So let me summarize the situation. It was a mixed quarter. There was a little bit of increase in problem loans, but that's not a big deal given that problem loans are such a low level. Profitability was down, which was a little surprising because profitability normally goes up in the first quarter. That's a little bit problematic. It makes the quarter a little weaker. In the long run, it looks like we're getting some loan growth and profitability should come back, but it's not happening right now. Of course, we welcome your feedback, questions, and comments, so please provide that, and thank you very much.